What's up, everyone? It's Caddy with MoneyVest. So markets definitely do have a bit of a double standard. I mean, Apple can decline in revenues and profits and yet not go down. I mean, only 4%, 3%. I guess on a market cap weighted basis, it is pretty substantial still because, $2.5 trillion market cap, 10% would be 250 billion, 5% would be 125 billion, 3% would be roughly about 100 billion, just sub 100 billion dollars, which again is more than the market cap of Enphase or of a lot of other companies that have been selling off like crazy. So that makes sense from a dollar denominated basis and market cap basis, but still it doesn't feel right. 3.5%, 4% is still way too low in my opinion for the type of earnings that we got from Apple. As always, if you enjoyed this video, I'm going to break everything down. Make sure that you drop a like, and of course, don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below if you're interested in joining, getting access to all the members-only benefits, trading view charts, all the intrinsic value spreadsheets, stock reports, everything's going to be included, as well as the MoneyVest Pro platform early access in 2024, and I will be doing every weekend how we do those technical analysis on the Magnificent 7 stocks. I'll reserve that for members only videos because I do want to go over some specific volatility data as well, which I think is going to be very, very useful and valuable for all the members. So links are going to be down below if you're interested in joining. So first things first, let's talk a little bit about the numbers. Of course, we got $1.46 in earnings per share, which was better than the expected number, 139, which was the EPS consensus. Revenue came in at just shy of 90 billion. The expectations were 89.2 billion. So beat on EPS, beat on revenue. The guidance was a slight miss. Actually, it was a little bit of a stronger miss because they said that the December quarter is expected to be similar to the last year's quarter. And this year we'll have one fewer week. And of course, there wasn't any formal guidance, but analysts were expecting for a 5% increase in year-over-year basis in the December quarter. In other words, this right here was the number $122.98 billion in revenue is what they were expecting. And Apple said it's going to be no growth, right? It's going to be flat to slightly down, which of course is a guidance miss. iPhone revenue came in line with expectations, 43.8 billion. Mac revenue was shy of expectations because of the slowdown in Mac sales. And iPads coming in 6.44 billion, strong beat. Services was a big beat, 22.3 billion. So massive contribution margin there. And 45.2% was the overall gross margin for the company. So if you take a look at the contribution margins to 22.3 billion, so 22.3 divided by 89.5, we're looking at 25% now, right? And I think this is really where the market is repricing Apple stock right now, and we've talked about it in the past and how the valuations expanded from 18 to 20 times multiple to now 29 to 30. The reason for this expansion is because gross margins have gotten better over time on the back of services revenue, right? Because of the fact that Apple's able to generate a lot of revenue on services now, 25% almost as of this quarter, their margins are expanding, and hence they are getting a higher multiple that the market is giving them. Now, even then, if you take a look at the overall numbers, which we'll get to here in just a minute, Tim Cook says, and I quote, "If you look at the iPhone 15 for that period of time and compare to iPhone 14 for the same time in the year-ago quarter, iPhone 15 did better than iPhone 14. In other words, they are saying that this is going to be a better selling phone, which I'm kind of having a hard time believing because the demand doesn't feel like it's there. There's been a lot of other indicators suggesting the demand is starting to slow down, and not to mention interest rates as high as they are, and the discretionary spend is also pulling back. So MacBook obviously did have a significant slowdown, but they're expecting a better quarter because they did launch their M3 chips. So we've got new products, and we don't have the compare phenomenon on a year-over-year basis, is what Tim Cook also mentioned. And the overall market for personal computers is challenging right now, and revenue from iPads was also slowing down, falling 10% for the same period last year as well. Apple services, of course, being the bright spot, recording $22.3 billion in service revenue, outpacing analyst expectations, increasing more than 16% from a year ago as well. So these are the numbers. Again, revenue did decline $383 billion. That's down from $394. This is probably the second time in Apple's history that we have seen a revenue slowdown. well, I guess not in history, but in the recent history, in the last 10 years, I should say, that they have seen a second time when the revenue slowed down. Gross margins 169 billion versus 170 same time last year, so slow down there as well. And overall net income was also down from 99.8 billion down to 97 billion. Analysts were expecting close to $100 billion, right? So we did see moderation in overall net income. And not only that, we did see a decline in diluted earnings per share. It continues to increase because of the significant amount of share buybacks the company is doing. And I think this is the financial engineering that Apple is really good at, is that they constantly do these buybacks that basically, even if the net income's down, this is what the crazy part is. Even if the net income is lower, their earnings per share is higher on a year-over-year basis. It's absolutely ridiculous how many shares this company buys back. This right here, America's 162 billion, so slight slowdown there. Europe, also a bit of a slowdown. Greater China, slowdown. India, Japan, slowdown. Rest of Asia, slight increase. Okay, this was the only geographic region that saw a very, very small increase. Everything else was down. iPhone revenue, same time last year, was lower. MacBook substantially lower. iPad here slightly lower. Wearables was lower, and services was up. This was the only bright spot, increasing on a year-over-year basis for the company. But hardware revenue definitely struggling a little bit. Now, balance sheet, again, phenomenal. I mean, we got $162 billion of cash and marketable securities. Total liabilities are sitting at $290 billion. Of that, term debt's at $95.2 billion. So again, very, very well capitalized on the overall balance sheet here, with massive amounts of cash and marketable securities sitting on the balance sheet. Now, if you come over to operating cash flow, $110.5 billion. That's again lower than what we saw last year, 122 billion. So free cash flows for the company, if you take out the payments for acquisition of property, plant, equipment of about 11 billion, we're looking at about $100 billion in free cash flow for the company, which is lower than the about $112 billion that we saw last year in free cash flows for the company as well. So if you do come over to our valuation, I'm going to plug in the entire net income number here. So we're going to pick up the net income number over here, 96,995. So we're going to plug that in, 96,995. We're going to grow it by 10% because that's been on average a very, very solid growth rate for Apple. And that's also the expected growth rate moving forward. 20 times P multiple, I'm still going to keep them at 20 because I think 29, 30 is, again, a little bit higher. For a company that's not growing as fast. Yes, there's margin expansion. And again, like, the thing is that margin expansion and share buybacks is all the growth that we're seeing, right? If you kind of peel under the hood, the actual net income and the revenues are slowing down, they're moderating, and they're not increasing at like 20%. So the real true growth organically is not 20%. It's closer to 10, might even be 8 or 7%. It's all the share buybacks, and the margin expansion, I guess, is very organic, and it's very true because services are playing a bigger role in the overall profitability of the company. But the share buybacks, like, look what happens, if I do 10% growth rate and 20 times P multiple and a 12% discount rate and 10% margin of safety, we look at a fair value of close to $102, right? That would put Apple today 43% overvalued, right? 43%. But just because they do share buybacks, so let's just do minus 5% here, all of a sudden the fair value jumps to $131, and now they're only 26% expensive. This right here is going to be the sensitivity grid that we track, very closely for most stocks. And you'll notice a 10% growth rate, 20 times P multiple, 131. Now, if Apple, let's say, deserves a higher multiple of 26, or even 27, we're now looking at a $171 to $172 per share for the company, which I guess, again, is not terrible. 20 times multiple is not bad, but it's still, like I said, it's still a little bit higher compared to its true organic growth that we're seeing for Apple stock. If you come over to discounted cash flows, we're going to plug in Apple. We're going to put in $100 billion, and let's just try to match those numbers. Let's come down to 10%, 12, let's do 20%, nope, 40%, 30%, let's do 28. And there we go, 29%. Basically, Apple trading today would need to grow its free cash flows by 29%, right? Actually, I haven't accounted for share dilution, so let me do that. Let's do 20 now, or nope, 22%. let's do 21. There we go. 21.5 is going to be that number, I guess. Yeah. So 22% almost is going to be that free cash flow growth that needs to be there for Apple in order to justify today's valuation. Now, how many people out there in the comments, let me know, believe that Apple can grow their free cash flows by 22% over the next 5 years? Yes, they have done that in the past, but the business has gotten so much bigger, so it's going to be increasingly difficult for Apple to grow at that size and that scale moving forward. So this is the overall technical analysis of lower highs and lower lows. As you guys can see, that we are consistently following up to that pattern. And after hours, we did drop quite substantially, a little bit over 3.5%. But like I said, there's a double standard. We should be down more, in my opinion. But next support is going to be all the way down to 164, 165. So this right here is going to be that support level to watch. And 157 is going to be below that level to also watch for Apple moving forward. And my fair value, my intrinsic value is going to be unchanged at close to $131 per share. So 131, close to 132 is going to be those levels to watch for Apple. So hope you guys enjoyed this video and a complete update on this company. Let me know your thoughts down in the comment section below. As always, make sure that you drop a like, subscribe to the channel. Link to our Discord, Patreon is going to be down below. Also, feel free to connect with me on Instagram. I do share a lot of interesting stories and posts over there as well. So always, happy investing. I'll see you all in the next video.